Welcome back to the channel, guys. We are back with another video. Today, I'm going to be showing you exactly how you can simulate yield in order to understand how much cash flow you can be generating consistently month over month with our new DeFi tool. Without further ado, I'm going to jump straight into it. Make sure to subscribe, hit that bell notification icon, and smash that thumbs up button below as well. And let's get into it. Okay, so DeFi Buddy is the tool that Alex and the team here at Cryptolabs has been working on for the past few months. And this is our new software that allows you to do a whole host of different things here in the crypto and DeFi space. But what I want to hone in on in today's video is showing you exactly how you can simulate yield for your liquidity pools in order to get an estimate of how much cash flow and yield you could be generating on a daily, monthly, and even yearly basis from executing different simulations here on the tool itself. Now, I do have to caveat this very, very quickly to say that there is ultimately no substitute for actually deploying real capital into pools and doing a test to estimate how much yield you can generate. And I'm going to talk through some of the parameters in the tool itself here right now so you can understand the liquidity position simulator, because there is variables at play here that you have to understand, or we are plugging into the simulator to spit out certain yield projections. And so when you understand those variables, you can understand how there is really no substitute for deploying real capital. But the goal of the pool simulator and the liquidity position estimates here is to give you ultimately that rough guideline as to how much you could be generating. And that can be very useful when evaluating liquidity pool opportunities across different networks, but also across different fee tiers for specific trading pairs. Okay, so in DeFi Buddy, you're going to be able to come up to the Yield Simulator tab here at the top of the screen. And as you can see here, we've got a position loaded in the position simulator. I've selected the Arbitrum network Uniswap v3 as the DEX and the version of Uniswap because I'm going to be providing concentrated liquidity in this V3 position. And then obviously WETH USDC is the token pair. So token A WETH, token B USDC, with the fee tier being the 0.05% fee tier here for this particular pool on the Arbitrum network. Okay, we can see that information below here. And as we scroll down, now I have the ability to input a concentrated liquidity price range at which I want to be providing liquidity. And by default, I believe you're going to be actually loading the page with about a plus and minus 10% wide range. And so right now, the current spot price of Ethereum is just under $4,000. And again, when we look at the min and max price here, we're looking at minus 10%, which brings us down to about 35.48 on the lower end, and then plus 10% up to 43.37 for the max price on the upper end. That is a full 20% wide range. Okay. Now, let's talk about the other parameters. On the price chart here, we've got the 30-day chart view. So this is showing us price data for Ethereum's volatility and price action over the past 30-day period. Again, we've had a relatively volatile couple of weeks here in the market. And so you're seeing periods here where the price of the actual asset in question, i.e. Ethereum, was out of range ever so slightly here during certain periods over the past 30 days if we're using this 35.48 to 43.37 range. And that is important when it comes to estimating the fees that you're going to be earning, because the way our pool simulator works is it's giving you the data based on how much fees you would have earned from being in this minimum to maximum range. And obviously, when you're not earning fees outside of this range, that's getting baked into the estimate that it's quoting you on this chart below. So if I scroll down here, it allows us to assess how much we're going to deploy into the pool, and it'll tell us the ratio split based on the current price of the asset and based on the concentrated range that we've defined. And this is the place that I think is going to be most interesting for most of you here, doing the estimation of the fees that you can be earning on a percentage basis. And again, we break it down here into 24 hours, 7 days, 30 days, and even 1 year. So I'm going to change this to a 30-day period on the chart instead of a 10-day period, just to show you the difference of what I mean here when we're estimating yield potential. Because when we're doing a back test, it's important to understand the period that you're back testing in. And obviously, because volume is another variable that we can't fully account for in any given time period, the back test period is going to play a role in the actual percentage that you're estimating. And so what this is basically telling us is, if we were to have provided liquidity at this concentrated range from 35.48 to 43.37, based on the past 30 days of price action and volume history, we would have earned about 70% APR on a yearly basis. Okay. That equates to about 5.75% over the period of a month and about 1.34% per week, or just under 0.2% every 24 hours. So that's a pretty good yield for an Ethereum trading pair. But again, we know that we've seen some volatility in recent days prior to me making this video. And if I was to change this number to just a 10-day look back or back test period, you can see that the volatility and the volume coming through this particular pool over the past 10 days means that if we actually just back test this specific range, again, the exact same range, 35.48 to 43.37 for the past 10 days, because there's been more volume over the past 10 days specifically, it's telling us that we would have actually earned closer to about 115% from providing liquidity in this range over the past 10 days. Again, extrapolated out to a 1-year period. That equates to 115%. Over a month, you're at 9.5%. And then over a 7-day period, you're at 2.2%. So hopefully you're understanding the mechanics there of how you can play around and tweak the back test period. And of course, that's going to vary depending on how many days you input here. If we zoom out even further back to a 60-day back test period, you can see the estimated yearly APR is at about 61%, a little bit over 5% per month, which is still phenomenal, don't get me wrong, but you're going to see how that tweaks and changes the estimated APR based on the back test period that you use. The final two things I'll mention here are the liquidity distribution and the volume history. So just like I was saying, when you look at that volume history, we've had more volume here over the course of the past few days compared to what we had, let's say, back at the end of September and even middle of September. Volume was relatively low on many of these days here in the middle to end of September, and we're having consistently higher volume here over the past couple of weeks, with even very large volume spikes coming through the pool. And so this large volume spike and the consistently higher volume over the past 10 days is what was contributing to the backtest period for the 10-day look back, giving us and quoting us a higher estimated APR. So you have to factor that into your decision making and remember what the average is going to look like if you're providing liquidity in this pool over an extended period of time. Next up, we've got the liquidity distribution. Again, this is going to vary and change over time, but what this is telling us is that there's actually more liquidity up higher in this particular range, because Ethereum did have a little bit of a pullback here in the day or two before I made this video. And so even though price is at 39.43 right now, we can see there's actually more liquidity distributed higher up the pricing scale here, closer towards the $4,000 and $4,300 area. And there's less liquidity down towards the lower end of our range here, towards $3,500. Now, that's not necessarily a bad thing, because if price is to hang out around here, we're going to earn some pretty good fees, because on a percentage basis, our liquidity is making up a higher percentage of the liquidity distribution towards this end of the scale compared to the top end, where there's a lot more liquidity residing and waiting for that price to jump back up. So again, these are all the different variables and parameters you need to be thinking about as a DeFi liquidity provider. I hope that overview was useful. I think there's a lot of utility and power in being able to simulate yield opportunities across different dexes, even just different networks and different fee tiers is important to compare and contrast. I've already spent enough time talking about the mechanics of how all that works on this particular video, but drop another comment below here today, guys, if you want to see more content around DeFi Buddy, yield simulation, and all the other powerful tools that are being built out inside of DeFi Buddy as well. Hopefully you can take some learnings away from this video. You can start putting the liquidity position simulator to the test yourself and start understanding and getting an estimate of how much yield you can be generating from providing liquidity to different trading pairs across different dexes, networks, and fee tiers. That is it for today's video, guys. I hope you enjoyed and got some value out of how to run simulations in our DeFi Buddy tool. Make sure to drop some comments below. Let us know if you want access to DeFi Buddy. And if you have any feedback, we're always looking to implement and improve the tool as well. Make sure to subscribe, hit that bell notification icon, smash that thumbs up button below. I was told over 33% of you are not even subscribed to the channel. So if you got value out of today's video, make sure to subscribe. We're dropping videos pretty much every single day here. You're going to miss out if you're not subscribed. So it is a sin if you are not hitting that subscribe button. Make sure to do it now, and we'll catch you in the next one.